Good afternoon, everyone. This is Brian Patrick with forextradealarms.com, and I have a new video for you today about correlation and how you might be able to use it in your forex trading. I've gotten quite a few emails about correlation this past week, and traders have asked me, what is it? How can I use it? So I thought I'd put together, actually it's going to be a teaser video for you because I'm going to be coming out with some more information fairly soon about correlation. First off, a definition of correlation. What is correlation? Correlation is simply the relationship between two pairs in the forex market. Positive correlation is measured in terms of 0 to 1.0. Negative correlation is measured in terms of 0 to negative 1.0. What does it mean if a pair is perfectly correlated on a positive relationship? For example, if a pair has a positive 1.0 correlation, that would mean that, let's say, the euro dollar here and the euro yen had a perfect 1.0 correlation. That would mean for every pip that the euro dollar went up, then the euro yen would go up 1 pip as well. Again, that's a perfect 1.0 correlation. Now, it's rare to find that. Probably you'll never find that, but some of the pairs you'll get kind of close. But it's rare to see that perfect 1.0 correlation. And the oppositely speaking, in terms of the opposite way, negative correlation, if a pair were perfectly negatively correlated, let's say the euro dollar and the dollar chef, let's say they had a negative 1.0 correlation, that would mean for every pip that the euro dollar went up, then the dollar chef would go down by a pip. And again, you're not going to get a perfect negative 1.0 correlation probably ever, but usually the euro dollar and the dollar chef have a pretty high negative correlation, sometimes approaching 0.90, 0.95. So, and I'll kind of go in and cover that in a couple of minutes here. Okay, as you can see, I have 4 live charts on my screen. Now, it is about 1 o'clock, 1:15 or so, New York time, on Friday the 18th, and these are all set to the daily time frame. I've got the euro dollar, the euro yen, the dollar chef, and the euro chef. And I want to look at the euro dollar and the euro yen first. Now, visually, as you can see, these pairs are pretty well correlated. Right about the first part of May, the euro dollar started a pretty good sized downtrend. And on the 7th of June, it started headed back up a little bit. Okay, and you'll see here also on the 2nd of May, the euro yen started its downtrend, and right about here, the 7th, it started going up. Now, it has not gone up obviously as strongly as you can see as the euro dollar has, but it's interesting to note that on the same day or so, the pairs have started reversing. So this is a pretty high positive correlation. Now, as you can see here on this candle here, it's quite different than the candle on the euro dollar. So something happened that day, probably with the yen, and the price kind of took a pretty sharp dip downwards. But you can see how there's a retracement candle here, just like there is here with the euro dollar. So now, it's probably not wise to place your trades basically using correlation as your only form of entry and exit. I would suggest that you use correlation like a barometer to help you, as a guideline to help you plan your trades. And for example, if you were in a euro dollar sell trade, let's say the whole month of May, you would probably not want to have been in a euro yen buy trade, the opposite trade during that month. Okay. Now let's say you had an even lot size between the two trades. You had a sell for the euro dollar, but a buy for the euro yen. Well, you know what? Your profits probably would have canceled each other out. Sure, you would have done really well in the euro dollar with selling that over, let's say, the course of a month. If you had bought the euro yen during that course, let's say you'd bought here the 2nd, goodness gracious, you would not be in a good situation. So all your profits from the euro dollar would probably have been wiped out. So when pairs are highly correlated, you probably would be best sticking in like trades. For for in this case, sell trades for both pairs. You probably would not want to do a buy trade for the euro yen. Now, of course, there are methods out there, counter trends and that sort of thing. But generally speaking, and I'm not going to go into those today, but generally speaking, for highly correlated pairs like this, you're best sticking off to similar trades, in this case, both sells. Now, I want to look at the euro dollar and the dollar chef. These two pairs traditionally have a high negative correlation. And when I name negative correlation, for example, in a perfect negative 1.0 correlation, every pip that the euro dollar went up, the dollar chef would go down by 1 pip. Now, again, this pair can have negative correlations as high as 0.9, 0.95. Traditionally, these two pairs are very strongly negatively correlated. And as you can see here, let's say on the 1st of May, the euro dollar started its downtrend, and actually on the 2nd of May, the dollar chef started its uptrend. And they kind of reversed right about the same time on the 6th or 7th. Looks like we've got a little doji candle on June 6th on the dollar chef. So you can see how these two pairs are not quite a mirror image, but you know, they negatively mirror each other fairly strongly. They've got a high negative correlation. So, for example, if you had been in a sell trade for the euro dollar during the month of May, you certainly wouldn't want to have been in a buy trade for the dollar chef. You would have wiped out all the profits from the euro dollar. Now, if you're talking short-term trades and some counter trend techniques and buying on retracements, those kind of things, then that's kind of a different story. There are plenty of methods and systems and strategies for doing that kind of thing. But generally speaking, you want to pay attention to the correlation values if you're considering trading other pairs. And I've just put the euro chef on here just to kind of show you, it's kind of all over the place. So it's interesting to note the different correlation values between the pairs. Now, you should be able to get correlation from your broker. Look on their website or maybe speak to someone in customer service. Most brokers will provide you with correlation numbers. Now, you need to remember that a lot of the data too will be historical. For example, during 2009, the euro dollar and the dollar chef had a 0.85 correlation or 0.90 correlation. That will change on a daily, weekly, monthly, hourly basis sometimes too. So keep that in mind when you're trading. Fundamental events certainly can play havoc with correlation. Some countries have histories of manipulating their currency, which I will not name. But non-farm payroll on a Friday afternoon, the first Friday of every month in the States, that could throw havoc with correlation too. So again, I would suggest you use correlation as a barometer, as a guide to help you with your trading. It's not the holy grail of trading. It's it's another tool to add to your arsenal. So again, as I mentioned before, I will be coming out with some more resources to help you determine correlation on your own and some more help with correlation. I really wanted to do this video because I had quite a few questions this week, and I want to kind of put a seed in your brain about correlation, get you to start thinking about it and looking for it on your charts and how you possibly might be able to use it in your own trading techniques. Again, this has been Brian Patrick with forex.tradealarms.com. I hope you've been able to glean some good information from this video. There will be more to come in the weeks ahead. In the meantime, I will see you on the next video. Have a great day. Bye-bye.